Estimated quarterly taxes. Today you are going to learn the who, what, when, why, and how related to this topic. Specifically, you are going to learn what are estimated tax payments, why are they required in the first place, who is required to submit these type of payments, and when these payments are due. But most importantly, I am going to show you how to calculate your estimated tax payment, and I will demonstrate how to submit these payments online on the IRS's website. My name is Sherman, a licensed CPA at mycpacoach.com, where we guide business owners to more tax savings and less stress. And today we are going to focus on the less stress part of the statement by making sure you are compliant with the IRS requirement to submit estimated tax payments. If you fail to submit these payments, then you may be assessed additional penalties and interest from the IRS. When I started my first business, if I am being honest, I personally made the mistake of failing to submit estimated tax payments, which ended up costing me a few $1,000s in penalties that I otherwise would not have had to pay if I simply complied with the rule. So unfortunately, I had to learn this the hard way, and I'm making this video to make sure that you do not. And if you watch this video until the end, I will provide you with a very clear demonstration on how to submit your own estimated tax payments. So if you want to master this once and for all, save this video for your own information right now, and be sure to subscribe to our channel for more videos related to tax that can help you on your business journey. All right, so let's break this all the way down. First of all, what are estimated tax payments? Estimated tax payments are advanced tax payments made throughout the year that are based on your taxable income. And the easiest way to understand this is to think about how employees are taxed when they are paid. So when employees are paid from their employers, they receive their pay after taxes are withheld. And those taxes that are withheld from their paychecks are submitted to the IRS in the state as their advanced tax payments. And if too much money is withheld from their paychecks throughout the year, then they would typically receive a tax refund when they file their taxes. Now, let's flip this around for self-employed individuals who own businesses or receive 1099 income. So when you receive a payment from your customers and you're self-employed, no tax is withheld from that paycheck. Therefore, no advance payment is being submitted to the IRS on your behalf as you collect payments throughout the tax year. But the IRS still wants to be paid in advance, just like employees, even though this money is not being withheld from the payments you receive through your business. And that is where estimated tax payments come into play. The IRS wants you to submit estimated tax payments as you earn income during the tax year. And since this money is not automatically withheld and submitted to the IRS like an employee, the IRS requires you to calculate and submit estimated tax payments to them over the course of the tax year. And just like employees, if you submit more estimated tax payments than you actually had to, then you would receive a tax refund at the time your taxes are filed. And if you do not submit enough estimated tax payments throughout the year, then you would likely owe tax on the difference when you file your tax return. So basically, the money you owe at tax time or receive back in the form of a refund takes into account the taxes you already submitted to the IRS during the tax year, if any at all. With that said, who is required to submit estimated tax payments? So in general, individuals who expect to owe tax of $1,000 or more when their return is filed are required to make estimated tax payments. This includes unincorporated businesses like sole proprietors and general partnerships, as well as LLCs and S corporations. This also includes employees who owe more than $1,000 when they filed their last tax return. However, employees could simply increase their withholdings throughout the tax year with their employer to withhold more tax from their paychecks if they choose to. So basically, If you paid more than $1,000 in additional tax when you filed your last tax return, then you likely need to submit estimated tax payments or increase your withholdings if your circumstances are expected to remain the same. Now, the only exception here is if you own a C corporation, which are required to make estimated tax payments if they owe $500 or more in taxes instead of $1,000. Anyway, let's talk about when these estimated tax payments are actually due. So technically, estimated tax payments are due on a quarterly basis. The due dates are as follows: April 15th, June 15th, September 15th, and January 15th. But what happens if you miss a payment by these deadlines? What can you do? So if you miss an estimated tax payment, we suggest making the payment you missed as soon as possible. And if you miss multiple payments, then submit both as soon as possible. For example, let's say you were supposed to pay $7,500 per quarter in estimated taxes, but it's December and you just realized that you did not make any estimated tax payments. In this case, we would normally suggest that you submit all 4 payments in December as one lump sum payment of $30,000. And in some cases, I've seen taxpayers in this same circumstance avoid estimated tax penalties because they still submitted all of the required payments before the end of that tax year. Anyway, I can't promise that will always be the case. So in general, you should aim to comply with the quarterly deadlines provided by the IRS. And if you miss those deadlines, try to pay those estimated taxes as soon as possible. Now let's address the most important question. How are estimated taxes calculated? It's quite simple actually. The IRS provides 2 methods to calculate your estimated taxes, and one is much easier than the other. The first method is to pay 90% of the estimated tax you expect to pay for the current tax year. This would involve you projecting your annual taxable income and expected tax liability and submitting 90% of that amount as estimated tax payments split into 4 quarterly payments. For example, if you expect to earn $100,000 in income and owe $20,000 in taxes, then you will be responsible for submitting $18,000 in estimated tax payments during the tax year, which is just 90% of $20,000, which would mean you would pay $4,500 per quarter to the IRS, which is determined by simply dividing $18,000 by 4 to account for those quarterly payments. Now, I personally find this method to be more difficult than the second method, so let's talk about it. The alternative method to calculate your estimated tax payments is to just pay 100% of the tax you owed on your last year tax return. For example, if you owe $10,000 in taxes to the IRS last year, then this would be the exact amount you should submit to the IRS in the current year to satisfy the requirement for estimated tax payments. Now, I like this method because if your income goes up or down, you still don't have to worry about being penalized for miscalculating those payments since you paid 100% of the tax liability you owed last year. For me personally, I just pay the IRS what I paid them last year and I don't worry about too much else. Anyway, for our tax clients, we typically provide them with a payment voucher with the exact amount of estimated taxes that they should be submitting to the IRS. So your accountant would ideally help you determine the amount of estimated tax payments you should submit, but if not, you can follow these steps or use Form 1040-ES as a guide to help you with this. Now, let me show you how to submit your estimated tax payments directly to the IRS. You can easily do this online via the IRS's website. All you have to do is go to irs.gov and find the pay section on the homepage, and you will see various options to submit payment to the IRS, and you can just click whichever one is your preference. And then you would click make a payment, which is what we are trying to do here. And then on the next page, you will want to carefully select the reason for your payment. We are going to click estimated tax here because this is what our payment would be for. The next big thing is to select the tax year you are submitting this estimated tax payment for. Now, this is important because this is the tax year your tax payment will apply to. And once you answer that, you will be prompted with some verification questions that the IRS uses to connect your tax payment to your Social Security or identification number. And then you can just follow the prompts from there to submit your estimated tax payment. But to make this even easier, you can also create an account with the IRS that saves your information and allows you to make and view all of your payments in one place. To do this, simply go back to irs.gov and click your online account from the menu or the home page. Then click sign in to your online account, which will take you to the page where you can create your account and log in once your account is created. Then once you log into your account, you can easily make a payment by clicking make a payment, where you would proceed to follow the same instructions that I just provided to you earlier. Simply select estimated tax payments, select the correct tax year, insert the amount of your estimated tax payment, and follow the prompts until it is completed. And that's it. It's really that simple. You would just do this once per quarter, and as long as you submit the right amount on time, then you should be compliant with the IRS requirement for estimated tax payments. If this video helped you, then I invite you to subscribe to our channel for more step-by-step walkthroughs. And if you are interested in receiving a step-by-step tax plan that is guaranteed to reduce your estimated taxes by thousands of dollars, then consider applying to become an exclusive client of mine. As always, thank you for watching, and I look forward to seeing you in the next video.